Welcome to the midweek trading session right here in Lagos, Nigeria. I hope your portfolio is looking good for the second half because we've seen the local bonds actually start off quite weak. But let's get you the top stories that set your agenda now. Start with the oil market. We see oil prices were steady in early Asian trade today with the global benchmark Brent. That's hovering near a one-month low at this time. It hit in the prior session, $83.62 a barrel, 0.1% down. And we see WTI crude, that's trading at $80.65 a barrel, also down 0.1%. So it's safe to say, looking at these two grades, for the past 2 months, they've been trading within a range. Brent between about $82 to $85, $86. But WTI has been holding on to this $80 mark, not going below it and staying there for too long at this time. So we're still seeing that trading range at this time. Let's look at the FX market now. We see the Naira depreciated the NAFEX window, but we see it's quite flat there, 0.07%. NAFEM, 1,576 Naira. That was a close yesterday. So marginal. So there's some kind of stability right there in the market. We're not seeing big swings up or down, just marginal moves for the close yesterday. Well, let's take a look at some forecasts now. International Monetary Fund has downgraded its forecast for Nigeria's economic growth in 2024. That's from 3.3% to 3.1%, citing weaker growth recorded in the first quarter of the year. The downgraded forecast, which is contained in its July 2024 World Economic Outlook, represents a 0.2 percentage points drop against the earlier forecast. As a result of the lower forecast for Nigeria's economic growth, the IMF also downgraded its forecast for sub-Saharan economic growth in 2024 to 3.7% from April forecast of 3.8%. However, the bank retained its 3.0% forecast for Nigeria's economic growth in 2025, while it raised the sub-Saharan African region's economic growth forecast for next year from 4.0 to 4.1%. All right, let's look at trade now. It was a historic moment for Nigeria yesterday as the country launched the preferential trade as part of the implementation of the African Continental Free Trade Area. President Bola Tinubu also lauded this moment in history. Was represented by Senator George Akume as the Secretary to the Government of the Federation of Nigeria. The ribbon cutting ceremony took place at the Apapa port yesterday in Lagos, Nigeria. Take a listen. They say the major sustainable path to economic prosperity is through trade, and with Africa's share of global trade at less than 4%, the Africa Continental Free Trade Area was birthed. About 4 years after ratification, the inaugural shipment under the Guided Trade Initiative is launched.
Today marks the culmination of efforts which began a little over 5 years ago with the official signing of the AfCFTA agreement in Niamey, Niger.
As Nigeria finally implements trade under AfCFTA, the federal government pledges to create an enabling environment to allow production for exports.
We will create an enabling environment that supports businesses, encourages innovation, and fosters competitiveness. We work closely with our continental partners to ensure that the benefits of AfCFTA are equitably distributed and that no one is left behind.
The launch of the GTI in Nigeria further highlights the commitment of this administration, led by His Excellency President Bola Ahmed Tinubu, GCFR, towards boosting economic integration, regional cooperation, and the transformational power of trade. Let me use this opportunity to recognize and appreciate the efforts of everyone who worked tirelessly and contributed towards the development and implementation of this initiative.
With about 11 exporters ready to ship goods to places like Kenya, Uganda, and others, AfCFTA certificates are handed to them. Stakeholders are optimistic about this moment, but concerns about currency still remains. What will Africa trade with?
If I'm selling something to Uganda, the buyer there pays in Ugandan currency, and then it is transcribed, given to me in Naira. So we're not using dollars at all.
First, this is a remarkable day for us that we are witnessing the inaugural shipment under the initiative, and that Nigeria has been enlisted as those pioneer countries that will drive continental trade. However, what is needed is for us to now ensure that we engage in this continental market in a beneficial manner.
As more exporters key into AfTA, it is expected Africa's trade volume will rise, but this also depends on provision of an enabling environment for production in Africa. All right, to our first conversation now, we see data from the MBS shows the Nigeria's manufacturing sector. That's a nominal GDP growth in the first quarter of 2024 is recorded at 8.21% year-on-year, lower than the corresponding period of 2023. So we'll see about 9% drop there when you compare both quarters for 2024 and 2023. The preceding quarter figure of 38.06% was also seen quarter on quarter, so we see a change there of about 9.64% down when we compare the first quarter of 2024 to the first quarter of 2023. Well, let's get an outlook for the second half of 2024. Could the manufacturing sector get a last-minute goal in the second half? Joining us now is Mr. George Norfolk, CEO, Coleman Wires and Cables, and he joins us right here to give us an outlook on what to expect. Great to have you on the show. Good morning.
Good morning, laddie.
So I remember sometime in 2023 when we were trying to get an outlook for the manufacturing sector in 2024. I remember the Director General of the Manufacturers Association of Nigeria. He did say H1 2024 would be tough. So I'm wondering, how tough was it? Or was there some kind of bright spot in the first half of 2024?
I think for anybody, it was extremely tough. First 2 quarters of the year, really. But it was predictable that it was going to be tough. Everybody said it. I said it too last year. We had a same sit, and it was going to be tough. And if you look at it based on your punchlines on the figures, 17 down to 8, it's definitely showing that it's a tough season. But it's predictable. And what I meant by predictable, if you look at all the statistics that we've all seen from the beginning of the year till now, we started the year with an interest rate of on MPC at 18.75. Today, we're at 26.25. So invariably, interest rate has gone up. That's knock one. Knock two, inflation. Started the year with 29.9% inflation. Today, we are 34.19%. And when you look at it, so inflation's gone up, interest rate gone up. We started the same year with a 950 naira to the dollar. Today we're at 1,500 average on NYFEX, but today it's gone up, it's devalued again, sitting at about 1570, 1580. So 1,580, so another set of knocks. So in terms of raw material purchase, GDP figures overall has come down. 3.5 at the beginning of the year, first quarter, second quarter, we're at 2.98. So invariably, the stats are literally against the word called manufacturing. So if you now look at the overall bottom line, listening to all those stats year in, year out, doing a comparative analysis, there's nothing else we can say that the knocks have been bad, the situation has been bad. But the question is, what are the learning curves from the first half of that year? And what are we supposed to do next as a whole? And I think not only as manufacturers, government, and every institution put together in trying to turn the tides. And I think that's the key thing going forward, is everybody knew the first half of the year. Sure, the whole of 2024 is going to be tough. If you didn't see that as a business and you're not planning your business for it, it's literally aiming for disaster, because clearly last year, majority of the manufacturers lost money on one factor, devaluation. So you had so much exchange rate loss declared openly to everybody. So if you're seeing knocks, that exchange rate loss creates a gap in your working capital. So if I have a gap in my working capital, I have a hole somewhere. And you have a hole somewhere, you're restructuring that hole. So you cannot see the same level of growth. And you know, when you dig a hole, and we're making it so literal, you dig a hole, it takes you time to actually close it back up. And so it's a time taking that we're seeing the figures coming out now. That the literary sense is that we dug a hole last year with devaluation, with removing some subsidies. A lot of things went on the knock by half year.
Definitely expected.
It was expected.
At the end of the day. Well, you did mention the rate hikes earlier for the first time. I think we had about 700 basis points altogether. And definitely that is going to play into CPI. But nobody's really talking about PPI at this point. That's the Producer Price Index. I'm sure that played into it.
It does, because when you look at it now, what are your indicatives in your Producer Price Index? Basically, you're looking at the pricing index of all products and the average pricing index of all products. Invariably, if you take all those statistics that has gone up, the prices of all products would have automatically gone up. But then the efficiency and the actual capacity would drop. So you're not producing at the same capacity anymore. Your working capital element has literally been eroded. You're not able to buy the same amount of quantities of material. So your efficiency levels of your production, maybe at before devaluation and all these other knocks, you might have been at 70%. Today, with your working capital, you'll be lucky if you're at 30 or 40% capacity utilization. So you have to have a knock on that. So it's inevitable. It's either you've plugged the gap, and I'll make it simple, and I try to sometimes make it a layman term for everybody to understand. If I bought raw materials at ₦1 million before, prior to the beginning of this year's half, and today, if you take inflation off at 34%, just making it simple, if we use devaluation, that's even worse.
Right.
If I take devaluation, I'll be knocking about 50%. So my buying value of that 1 million would only buy me 500,000 naira worth of goods today. So invariably, if my 1 million brought me 10 products, today it's only buying me 5. For the same 1 million. Now, you put 5 through that same production, you're not running at whatever capacity, you have half the capacity. The value, and we should also not be very careful not to look at the figures coming out in terms of turnovers. Turnovers are going up. Of course, it's going to go up. Why would it go up? Inflation is rising. Inflation has gone up. Naira has devalued. Of course, your turnover goes up.
So don't be too excited about it.
Don't be too excited. I think we should all ignore everybody's turnover today. Because I always say, look, turnover is only a figure on your books. It's not profit. It's not increase. It can be just a figure. And that makes simple. If I take the underlying inflation figures off your figure, and one thing people don't actually want to do, which is the other one, take the devaluation figure off your turnover. You'll find out that 90% of the companies you see in their statistics never grew. Because that is a figure, a benchmark that is a harder figure to actually declare.
When you see the headlines for some of these results, you see, earnings up 100% and all of that. But if you look deeper, read between the lines.
Read between the lines. My own others benchmark is to take devaluation. Because devaluation is always worse than inflation and interest rate. So if you take devaluation as a benchmark of everybody's figures, you find out that 90% of people declaring their figures did not really grow anywhere. So invariably, we have a problem. And when you're seeing those figures come out, it's sad. But it's a figure we knew, based on what was going to happen, that we're going to be taking the hit. The question now we always have to ask is, how do you actually turn the tide?
Right.
And the turning of the tide is, I'm a big believer is, if you know you have a gap coming, the question is, how do you close the gap before it happens? Or when it does happen, what do we do next? And that's where the monetary policies that they've done, basically, if you look at all the macro policies, are going in the same line of everything every economist or financial analyst would do. But the question is, you can only throw so much into a macro policy without having a fiscal policy balancing program in place simultaneously. Now, it seems finally, let me use the word finally, it seems we're trying to do fiscal rebalancing. If you look at it, some of the introduction, pharmaceutical grade raw materials being zero duty, the 150 days window. And Someone says food. I say, no, don't look at the food. Look at the manufacturing processes of some of those food items. Maize is a key ingredient in food feeds, especially for all animals. And we have actual factories that actually produce.
Some are complaining about the price of the crate of egg at this point.
Yeah, because the crate of egg will be expensive. If the price of my raw materials for putting the feeds in, like maize, it's more expensive.
Right.
And when you look at it, it's become a problem. So invariably, that comes in. If all of us, because you have to have a fiscal balancing also between food and processed food, right? What I mean by that, if you look at it, there was a point in time when everybody shouted that ethanol is better than even petrol, that we should. But ethanol was coming from sugar cane and was coming from maize and and it became a problem that we were all running out of food in the world. And that became a problem. Everybody had to review that position. Now, we need maize. We don't have enough production in the country for maize. But we need maize also for the animals to actually eat. And this has to be processed in certain industries to actually create food feed for animals. And that price has to come down. If those things don't come down, me and you, eggs or each other product, will take a knock-on effect, because the same person using in that agro product is also using the same feed that it has to recover cost from. And those are what is creating inflation, and those are what is creating benchline. If you look at core inflation really, and you look at the year-on-year figures, we had year-on-year figures on food inflation at 35% at the beginning of the year. It's 40%. At the current today. Right. But if you take out the benchmark of 34% of inflation, 29, the month-on-month, good thing is it's coming down. So the month-on-month started at about 3.5% at the beginning, and it's dropping down to about 2.55 on core inflation as it affects food.
That's basically the only bright spot, at this point when you look at the data.
But for a manufacturer, it saddens me that we look at interventions as no more a solution, because we're in a bad situation of where means and other means in terms of the volume of money that has gone into liquidity is too much, right? So fair enough, central bank is trying to close the amount of liquidity in the system and create a better scenario. Now, but the reality is, gaps has been created. People have lost money. Now, if I've lost money, I'm producing less, I'm going to pass the cost to you.
Right.
So
how much can the consumer really take?
So you're going to see this at 8.2. There's nothing about it, because what has happened is that cost has gone up, production capacity has dropped, and as production capacity has dropped, your figures automatically drop.
Right.
Your turnovers might be going up. It might be looking as if you're doing more turnover. Government might be looking as if they're getting more taxes. But please, I keep telling them, take out the bottom line underlying factors, right? Take your benchmark and look at them.
And I think we saw CIT actually dropped in the first half of 2022, the first quarter of 2024. So we're already seeing the signs.
We are seeing the signs. So what the fiscal policy now is going the right way. Let us get it. But now, what I always also would suggest is, let us look at other areas of fiscal balancing. Why today? Yes, we have the IDEX system, which is the import duty exemption certificate for importing machinery for industry. The process is still very complicated. I'm sorry, it's an online system that needs a minister to sign one letter that literally is hard to get now before they can even process it. I don't know why we have to do that for any manufacturer in Nigeria. I speak to a lot of companies from different countries. I speak to individuals from other countries, and they laugh when you tell them you're paying duty either on raw materials or machinery. For what? I don't understand. Why do I have to go through a process? If I want to invest in machinery, I shouldn't need anybody's permission. I want to invest in machinery. Make those machinery zero duty, pure and simple. We've done it before. We went from, and that was in the government during when the minister was Okonjo-Iweala. She took it down from 2.5% and made it zero. It was first, she was the one that actually brought it down to 5%. Then from 5%, it went down to 2.5%. Then it went down to zero. Only criteria is you have to just prove to me you're a manufacturer. Go get your certificate from MAN or whatever and show to me that you're a manufacturer. I will give you zero duty. Bring the machinery. And the machineries came into Nigeria in droves because the cost of entry, you've just reduced it. The barrier and business ease of doing business. I don't need to spend the whole day or the whole month or the next 3 months chasing a letter from a minister to support my online application. I don't think that is necessary. I don't understand that.
But definitely we need to streamline most of these processes. If it's online, if it's offline,
they make it very simple.
You streamlined very well. But thank you so much. It's always great having your perspective, Mr. George Nofowokun, as the CEO, MD, Co-Man, Wires and Cables. Thank you so much.
Thank you very much for having me.
All right, definitely. Looking at the H2 outlook for the manufacturing sector, still looking like it's going to be another hard landing, at this point. But we're going to find out soon, definitely. We're going to take a quick break now. When we come back, we're going to head straight to the market. Do stay with us. This week is looking good for the local bourse. If you're comparing the previous weeks, we've seen about 2 green closes already for the past 2 trading days. But let's get a check on what's driving sentiment. Joining us now is Mr. Mukhtar Mohammed. He's the CEO of Finance with Mukhtar, joining me via Zoom. Great to have you on the show. Good morning.
My pleasure.
So it seems the second half of 2024, that's if you're looking at the local bourse, is kicking off quite weak, at this point. But we're seeing some kind of movement this week. But do you think what we've seen so far in the second half is the beginning of a big correction in the equities market?
Well, you can say it's a correction per se, but again, you have to look at it as the area of perception and fundamental coming into play in the market this moment, because a lot of people are beginning to see value when those prices come down. And I can say most of those downward trend in the market was largely driven by the financial sector. And you and I know why that happened, because of the recapitalization of banks. I said in your program some time ago that until we have a clear-cut direction of where these banks are going in terms of their recapitalization plan, you'll continue to see those ups and downs in those equity. And I think for now, everybody know where they're going. Everybody have a clear-cut direction on how they want to raise funds, either through public offer right issues. And I think so investors are beginning to see value and looking at fundamentals. Now, value and fundamentals and perception are 3 things that really play in the market at this moment. Perception is in terms of corporate governance. What do you see in those companies? What are your own individual perception on it, or what are your trading pattern when you look at this company? Fundamentals has to do with a lot that has gone on in these companies thus far, looking at what they have been able to achieve, what they are planning to achieve with the right issue. Value also have to do with, as an investor, what are the value that you get in this share, especially in terms of dividend payout going forward and price appreciation. So all these 3 issues are playing at the market at this moment, and it seems to favor the market, and that's why you're seeing the upside you're seeing now.
Right, and definitely we know most of these companies are trying to raise funds at this time. We've seen the banks already hitting the market. But how difficult is it, raising money when there's a cost of living crisis if you're trying to actually get retail in? Because we know the institutional investors would also be hit a little at this time.
I think, Larry, you've hit the nail on the head. I think that's the challenge. You're going to... The market is going to lose a lot of retail investors, because some of them might not even have the capacity to take their right. Some of them bought these stocks at an all-time low. Some of them bought it below 10 naira. Some of them bought it at an average of maybe 12 to 13 or 14 naira. And so you're giving them 50% of it. It's going to be very, very difficult. So most retail investors might not be able to take all their right issues. And that is a challenge for the retail investors. But for the institutional investors and the high net investors, they see that as an opportunity now to begin to amass a lot of these shares because they know that a lot of retail investors might not be able to take all of their rights. So I totally agree with you. We'll see a situation whereby the market may not get so much of retail investors any longer. What you get is high net investors and institutional investors. But in the long run, you realize that high net investors and institutional investors tends to drive capital appreciation, while retail investors seems to sometimes stay because of the good dividend payout, looking out for passive income. So we'll see the market have excited days ahead of the market in terms of capital appreciation and dividend payout. But if you look at the plans, what each of these banks are planning to do is good, what they're planning to do. But like you said, retail investors will have serious challenges taking over their rights. So it might just go to the institutional investors.
Okay, so what's your advice to that retail investor that wants to invest but has to also decide, do I eat or do I invest some of this money? Because we also have some of those, wannabe investors, at this time that are trying to look long term, see how they can actually accumulate wealth. What's your advice?
Yeah, my advice for them, if you're a retail investor and you've been in the market for a while, if you've been in the market for the past 2 years, you realize that your equity has been able to beat inflation good time because you've seen over 100 and something % gain in some of the price appreciation, not talking about the dividend payout, which has also increased by over 100%. So my advice for them is to see how much of those rights you can take with the little of funds that you have, and also to look at the possibility of even taking up some of these stocks, especially when they come down, because definitely, like we always say, the market is not upside. There will be times that they may create an opportunity for them. But for now, my advice for them is to make sure that you see out of those little funds that you have to eat, if you can put aside some to take some of your rights, and then hopefully believing that future income will come up. And I need to say that some of the banks also have good strategy whereby they are telling their investors to reinvest their dividend pay. Some of them are saying that we won't come to the market now until after we pay interim dividend. So that will give our retail investors opportunity to be able to invest some of those interim dividends back into those equities. So the strategies are different, but again, for retail investors, I think it's time to really look at the long-term future, like you've said, take some of those rights and don't just allow them to pass by, especially with the kind of capital acquisition you've made for the past 2 years, being able to make you afloat of inflation.
Yeah, definitely not an easy time to be an investor, but it's always great having your perspective. Mukhtar Mohammed, CEO of Finance with Mukhtar. Thank you.
My pleasure, Ladi. Thank you for having me.
All right, let's get a check on the close for yesterday. Back above 100,000 level for the all-share index, but just holding it by hand's breadth there, but 0.11% up, and we see 62 billion naira that was made right there in the market. That's it from me on Business Morning. We'll give you a summary of the stock market close later on today. Thank you for watching. I'm Ladi Williams. I hand things back over to the Sunrise Daily team.